Richard, thank you for joining us.
Thank you for having me. I appreciate it.
Of course. I want to start with talking about just the lending environment. So we've seen interest rates rise this year. We've seen a lot of movement in terms of the availability of deposits and the way that consumers and businesses are thinking about borrowing. What have you seen from your angle in terms of being chief lending officer at California Credit Union in terms of the changes in the lending market and kind of maybe things that are happening around San Diego that might either give you pause or some optimism?
Sure. No, those are great questions and things, I have to think about all the time. Like I'm sure like every other financial institution, but the lending landscape here, what's been interesting is you got to keep lending. And I think what happens is with liquidity, the way it's for a lot of financial institutions, we see a lot of financial institutions still lending. We see a lot of them pulling out of the market, and that's either through they're not offering the product offerings they once had, or they're pricing it in a way that it makes them out of the market, so it's not like offering anything. And so I think it's important for our membership that we're still offering competitive pricing, and by not doing so, it really exacerbate your liquidity issues, because what happens is if you have members that have demand and for a product, for a loan product, and you're not offering it to them, the demand doesn't magically go away. They just go seek someone else for that product. And what happens is, most of my career, it's a little background, I spent most of my career in business banking, commercial loans, commercial deposit gathering. And I always went after the deposits, because not everyone needs a loan, but everyone needs a deposit. And typically when they finally need a loan, they're going to ask who they bank with for that loan. So what happens is, going back to the issue, if you're not offering loan products, you're giving someone an opportunity to kind of backdoor your member and take them from you, and then take the deposits they do have. So it could exacerbate your issues. So the landscaping here and the struggle has been a little bit of, how do we stay competitive? How can we continue to offer competitive pricing? Obviously, spreads aren't what they were, but we got to remain diligent in that area, as well as, we've been so fortunate with pricing on deposits the last 20-something years. It feels like probably not that long, but it's been so low. You have to give it. It's time to pay it back. So we're paying it back to our members in deposit products, and deposit pricing. But you can't just do that and get rid of your loan pricing and outprice yourself there. And so it's been that juggle. It's been, I would say, it's been a little bit difficult, to continue to stay on top of that. And we're not going to always obviously offer the best rates. No one can ever say that, but you always want to be competitive. You want to be in the market. You want to do the best you can for your members. We owe it to them.
Yeah, and it's been funny to watch because something intriguing you said that I've also heard in other parts of the industry is that you've actually seen, a quote unquote stop of lending, right? Where you actually have institutions who are either pricing themselves in such a way that they're not going to drive anybody toward them, or they basically remove products from market. From California Credit Union standpoint, have you all, in your mind, been more focused on driving deposits, loans, or kind of somewhere in the middle in the sense what you're maybe trying to do? Because I've seen this also happen with a lot of credit unions and also commercial banks, where they're almost trying to lend themselves out of the problem in the hopes that the deposits will come. And rather than trying, because I think this is the most intriguing thing you said so far, is that you've got to be focused on getting the deposit, because everybody needs a deposit. And the idea is you actually will lose those deposits to some other place if you're not thinking about that relationship primarily. And that's something that I hear all over the industry, is that there's this sort of fight for deposits, but sort of weaving the two together strategically. I'd love to hear your thoughts on how you all look at that.
Sure, and very exactly what you said is how we are trying to do it. To be fair, it's obviously more of a focus on deposits, but you got to continue to offer good loan products and stay relative. And at the end of the day, what do we do two things. We take deposits, we make loans. You got to do both of them, and you got to do both of them well. And not only on the deposit side, but we had Silvergate Bank here in La Jolla, and obviously the things that happened with them. So we have a big business deposit clientele. So there's a lot of concern. So some of the deposits issue that we ran up against was just giving people peace of mind that the deposits here are, are safe. And it's different because, a lot of banks failed in 2007, 2008, and it was for different reasons. It's not that we were having different challenges, but sometimes not everyone's up to what's the difference. They just know what's bad, and my deposits could be at risk. And so, for us, we're just trying to find ways to offer competitive deposits, obviously pricing, but especially on our business side, and take advantage of that. We offer a full business product line. We offer analyzed checking, sweep accounts, ZBAs. So one of the initiatives we try to do is that our businesses, they trust us. So this is real relationship kind of banking here. And so we say, hey, if maybe you guys will let us go in there when you have new employee orientations, almost like a seg development. Let us go in there. Let us talk to your new employees. Maybe we can set them up for direct deposit, have them bank with us. So when our business does payroll or those things, that money is just being transferred from one account to another, but still with us. And maybe we can give priority pricing or some kind of preferred pricing or something on both ends. Direct deposit pricing. When we look at annual line renewals for our business loans, maybe there's preferred pricing there. They can get so many of their employees signed up with us. So it's trying to really leverage those relationships, because a lot of times you have a real good relationship. I think it's what credit unions do well. A lot of times it's not the relationship is what matters the most. And the person I always think of is a person I worked with for a long time. He's retired now. He was a long-time business banker. He worked here, and he had a bunch of clients, and they've been with him since one of them told me since 1971. And they said they only remember the banks they were with. They just remember he was my banker. And so those relationships kind of matter. So we have to leverage those relationships and really take care of our members, and especially at a time where economic uncertainty, things are more expensive. They're looking for some type of financial guidance. And I think that, credit unions for businesses and for consumers, we can help fill that where, it's hard walking into a very big bank and getting that kind of personal touch that you would at a credit union. So I think it's leveraging those things together, leveraging the relationship, and really take advantage of all the hard work everyone's done over the years to establish, each member. Mm-hmm. So the focus is really on both, but it is primarily deposits because it's just, more advertising, obviously more dollars are going to be spent there right now, but it's, we're not just trying to get, hot money. We're trying to get money, and a lot of our deposit growth has been from existing members who have it at other places. They bring it to us, but now it's keeping it. How do we keep it? And if it's not with us, if it is going to go out, maybe we do it through our wealth management department, but really taking care of, being that full financial institution for our members.
So just as a reminder, the question was, is there something about San Diego that's changed or things that you feel like are differential vis-a-vis parts of California that it's like, wow, this is something that I didn't expect?
I think that's a great question. And I think a lot of what we're seeing here, we're seeing throughout the state. So I don't think it's specifically unique to us, but what I have seen a little bit more of, we have gained a lot of deposits because of what happened with Silicon Valley Bank and Silvergate Bank. We saw an increase in our uninsured deposits go up a lot because the safety. And so, that was a little unexpected. Early on when we heard about this news, I was getting calls from clients that have been with me a long time, and there was concern. There was concern to hear this news, and they don't know, maybe you're in the same situation. So what's going on? And so, we had this, I thought this was going to be a fight the whole year, trying to maintain deposits, letting know people are sick, or they start taking part of their deposits elsewhere and doing these things, which still hurts. And it really became the opposite. I think once credit unions, we didn't take any losses during the recession, deposit losses and those type of things. I think people started feeling a little bit better about maintaining their deposits, and we actually got more deposits driven to us over that. But I would say the key to that, though, is because we've picked up a lot of new clients. It's really, you still have to offer all the services that they would get at like a community bank. And I
Yeah.
think I'm starting to see a lot more credit unions try to offer those products now. It's a little difficult to get into the game when you're in the middle of it, but you still got to do it. And we have calls all the time. We try to help we want to be a good business partner, so we help other credit unions, try to focus on getting a cash management system that works well. And we've been doing it here for such a long time that we have a lot of those things in place. I think the hard part is convincing businesses that we have those tools in place. I think a lot of times you probably, I know you're on the board at Redwood, right? That's a good size that's a strong financial institution. And sometimes you run across people who think that, oh, well, you just offer like CDs and like car loans, right? And they think
Totally.
that you're just kind of a one branch location. And obviously credit unions have grown a lot, and there's still small ones too, and there's of all sizes. But it's convenient. A bank doesn't always know those things. Oh, I'm sorry, a business doesn't always know that, and so they don't know if you can bank them. So I think it's getting over those hurdles of we do offer those products and services that you have, and we try to do things like we said, give us your analyzed statements. We'll go through them. Hey, we're not gonna, if we can't beat you, you can't get better pricing with us, that's fine. We'll tell you. But a lot of it is now not about pricing. A lot of it, for especially deposits, is safety. So they want to make sure they're not trying to arbitrage their deposits or anything.
Right.
They got to make payroll. They got projects they're on. They got to make sure that money that they have for their operating needs is going to be safe and there for the way they intended it to be.
Absolutely.
So I would say that's.
Oh, go ahead. I'm sorry.
No, that was it.
Oh yeah, no, absolutely. And I think that what's been funny this year to me as an economist is that you have people who are actually thinking that because of what happened with Silicon Valley Bank and kind of the concentric circles and connectivities around it, that there's this sudden lack of safety and security in banking services across the board. Where then it's almost been like this re-education issue of being able to say, hey, look, don't freak out, don't get too nervous. You just recognize that we are thinking about those things all the time and that the money is safe. But it's just enough to spook people. And that's the one thing too, is that the last thing you want to do is have a flood away where people aren't putting it somewhere. They're unbanking themselves because they're sweating it. That's the one thing that the credit union industry has been fighting for a long time, is people being unbanked. Now you're like, the last thing you want to do is drive people back to making that kind of decision on the margin.
Oh, absolutely, and very, well said. And that's the struggle, that I think we all kind of go through, with just maintaining deposits, being on the cutting edge. I remember 20 years ago, no one really wanted to put their deposits in a online like bank or online, because it's like I need a building I can walk into. I need to know that my money's there. And through time, people are becoming much more. They feel a little more better about that, and they trust the internet's been around a long time now, and so those things aren't as uncommon. So it's for us, it's like how do the struggle of, we got to offer good pricing, but we do have brick and mortar, and that is an expectation that members have. But at the same time, you have a lot of other members and newer members and younger members who they don't care about those things. So it's staying on top of all those things, on top of the safety and making sure, because a lot of people, when they might just feel like, well, my money's just safer at a large national bank because they just got a lot of money, right? And
yep.
And it's like, well, it's not your only option, but I understand it. And it's how can we give them the message that their deposits are safe here too, which history has shown that they are.
Absolutely.
So and the other thing too, on the small business banking side, too, that's really helped. For a long time, so we offer commercial real estate, we offer small business banking loans, we're a preferred lender with the SBA, but we've always made it a requirement that non-commercial real estate, those are a little more transactional, but on our business, that you got to have your deposits with us. It's a part of us monitoring the credit, and a lot of times early on, it's a hard thing to hear if you've always been in credit union space. But if for small businesses who have been in the business banking area for a long time, and been with community banks, that's a requirement everywhere. So
Right.
having those type of requirements and those kind of things helps with those. And it's just more about the relationship too. It's about having to offer a full relationship. So, those kind of things has definitely helped us, for sure. But it's still a struggle because in San Diego, there's a lot of banks down here and a lot
Oh
of
yeah.
business banks, and a lot of them that do it well too. So
Mhm.
it's a constant struggle and constant fight to not only acquire new members and new businesses and new deposits, but keeping the ones we have too.
You bet. You bet. It's a constant bombardment of advertising and competition, no doubt about it. So, Rich, before we wrap up, I'm actually going to do a quick overview of how I see things going on the macroeconomy side. Uh, Folks, in general, what the Federal Reserve has been watching most has been this slide right here. This is what we call core personal consumption expenditures prices, or basically a measure of the change on an annual basis at the percentage of it costs you to buy all the stuff you have at home and you buy, but we're going to pull and makes it core food and energy prices and products and services out of that basket of goods. So the blue solid line is the evolution of that percentage change on a monthly basis, looking back to January 2007 through October 2023. And one of the main reasons why today we did not see the Federal Reserve change rates and actually kind of signaled that we're going to start the process of going back down the slide in 2024 is because that blue solid line is actually beating expectations, which are those red dots in that shaded area, through 2026. And as long as the Federal Reserve is forecasting that we're going to move those inflation or this specific inflation rate through those red dots, the more we're going to see rates moderate in terms of the short-term rates that the Federal Reserve helps set. And we should then start to see some relief on relatively high rates and hopefully a reacquisition of normal yield curves in terms of the way we're seeing loans and deposits. But if we look forward, the things to watch is that we expect that slow fall. As economists, we've been talking about it for a few months, that the data are starting to show their face. We should expect the Federal Reserve to start to fade those rates. And we should not now expect one more rate increase. There was a lot of debate in the summer and early fall about whether or not the Federal Reserve is going to increase rates one more time. That looks much less likely, especially after today, where we saw the Federal Reserve talk about that they're actually going to start fading rates, or at least signal they're going to start fading rates sometime in 2024. But we should not expect them to lower rates until they feel very much that the job is done, specifically that jobs growth is starting to fade in such a way that that's not going to exacerbate inflation pressure in terms of income growth, leading to more consumption growth, and that those inflation data continue to move through those red dots. That's absolutely critical. The blue dotted line on this graph is a measure of where the Federal Reserve wants to see so-called inflation expectations, kind of weaving the blue solid line around the blue dotted line over time. The latest forecast, and this is also helping the Federal Reserve thinking about fading rates, is that in November 2023, the Philadelphia Federal Reserve interviews 40 forecasters and asked them a bunch of different questions, and also asked them about their median forecast with a bunch of different variables. The three I pull out are real GDP growth, or think about income after inflation. And that first shaded area is the new or last quarter's, well, I shouldn't say that way, the current quarter's forecast when they asked them about their assessment after quarter three was over. And you can see that the previous quarter, which is the unshaded column to its left, there's been an upgrade for this year, 2023, and its end. The third quarter of 2023 was an amazing increase in growth, beat most forecasters' expectations, and that sort of positive growth will at least linger somewhat into 2024, but that will fade in 2025. And the weird thing about economic forecasting is that when there's a lot of uncertainty, but you know that pain is coming, you tend to just push that window of pain down the road every quarter if you haven't quite seen its appearance yet. And forecasters are kind of in that mode. If I'd showed you this forecast a year ago, most of the pain was going to happen in 2023. Now it looks like the pain is coming in late 2024 and 25. And part of why the Federal Reserve is saying they're going to start fading rates is because the forecast, which I'm going to finish up here in just a second on, are telling the signal that the pain is coming. And what they're trying to do is, in a sense, sort of soft land the economy in such a way that they fade rates just as the economy is starting to make its final transition with the higher rates we've seen over the last 18 months, and then weave into a better tomorrow toward the latter part of this decade. The labor market is showing signals of worsening marginally. So all those shaded areas that are the latest forecast for unemployment are a little higher than their sister forecast from one quarter before that, the previous column, but not by much. And most economies would absolutely love to have unemployment rates this low. And it suggests who's ever coming on the labor market is being absorbed by job openings and by employers looking for workers. The inflation forecast is exactly what we saw in the last slide in terms of the red dots. And so we're expecting that the economy is going to remain relatively resilient going into 2024. There are a couple of forecasters talking about a mild recession that might last 2 quarters in 2024. But even at these numbers, the risk of recession is relatively higher, but not that high. The critical factor is how long does the pain linger around once it starts to show its face? Do we see job losses that linger for a longer period of time? Do we see a little bit higher unemployment rate than we expected? Is there a combination of factors that start to change the way that businesses are making decisions? But right now, we're not seeing any of that in earnest. Now, if we look at California's labor market, some strange things are starting to emerge. And in essence, and to a certain extent, California's labor market is showing what the Federal Reserve was trying to do for the national economy about 6-8 months ago. And some of it's going to be a transition California's been going through ever since the pandemic. The blue line is the number of people who live in California and are either working or looking for work, what we call the labor force in economics. And this orange line are the people that are actually working from that blue line. So the difference between those two lines is the unemployed in California, the way we measure it. Now, notice that neither one of those two lines, if you look at the far right-hand side, and these are monthly data seasonally adjusted since January 2010, neither one of them have gotten back to their pre-pandemic peaks, which is right before the big cut in both graphs. If you look at the way that California employers that are based in California have hired people, that is actually now above the number of people that are working for an employer in California since before the pandemic. But the total number of people working for an employer in California exceeds the number of people who live in California that have a job. Now, what that suggests, especially if you look at what happened before the pandemic, and there was always a space between the black line and the orange line, is that employers in California have actually hired or have been okay with their workers leaving the state, or workers from outside of the state are being hired. And the combination of those two things are shifting the way that California employers are considering hiring workers to a more national market, and perhaps more global, but certainly more national. So that's a little bit of a tricky trend. And the intriguing thing about that is if we look at San Diego as a microcosm of that idea, we're going to see basically the same phenomenon. Now, San Diego has recovered a little bit better than most of the metro areas, except for Sacramento and Fresno in California. The Bay Area is still very much looks like what the state does on average in terms of labor force and the total number of people that are working who live in that area. And San Diego kind of has that gap just like California, but is a lot closer and has kind of flirted with full recovery. But notice here's the phenomenon of San Diego-based employers that are hiring from outside the area, that San Diego employers have allowed some people to live at distance, and those reflections are now showing that gap between who lives in San Diego with a job and the number of people working for a San Diego-based employer is basically now there's more people working for San Diego-based employers than actually have a job and live in San Diego. Just a very strange twist in the post-pandemic world in the way that employers are utilizing workers. If we look at housing markets, San Diego has stood out. So one, over the last 12 months, a lot of counties in California have actually lost median home price, meaning that we've lost a little bit of wealth because of higher interest rates, slowdown in demand. But to a certain extent, housing markets have been relatively stable. San Diego, you can see, has picked out there 3.9% as of October this year, looking back 1 year. And that has been part of a large growth cycle in San Diego, which is almost 41% over the last 3 years. So if you think you were at $1 million at the median price of a home in San Diego 3 years ago, now it's a little over $1.4 million. That increase has gone up a little bit more at a time where most of California has sagged a little bit on housing prices, as well as other metro areas in the United States. So San Diego has shown a lot of resilience. It has global demand. The business environment has picked back up. There's a lot of reasons why people have remained or sort of just switched housing from rental into home ownership over the last 3 years in San Diego. And if we look at the forecast, which you can see there's San Diego just over the last year, San Diego over the next year in a very volatile forecast environment for housing is basically flat. So most owners of homes would take about 41% growth over 4 years and run with it for a long period of time. That's kind of what the forecast is right now in San Diego. But if you combine what's been going on in labor markets, the forecast at the national level, and what's going on in housing, we expect San Diego to be relatively stable over the next 12 months minimum as we weave through this process of figuring out where A, the national economy is going, and B, where our state and national politics are going in a much more risky global environment as well. One thing I wanted to say before we go back and finish up with Richard is check out the league's resources on training and education. It's called eTrain. Angela Daly will take care of you. That's her contact information. Please check that out for anything you need in terms of educational resources for you and your staff. The league's got a lot of depth and breadth there. So, Richard, what I wanted to do is I wanted to end by asking you how you all are seeing next year. So, like I just said, a lot of the indicators are pointing toward a slower 2024. San Diego, in terms of California, is a little bit of a standout and has been for 2 decades plus, but it's showing a lot of resilience vis-a-vis other parts of California. How are you all seeing San Diego as a place to do business, as a place for members to live and thrive over the next year and beyond?
Those are great. Your slides are, they really set me up for what I'm going to say here. But we've been pretty fortunate, San Diego. We have a strong infrastructure, healthcare, hospital, education. You got a strong financial, professional sector, a strong, it's a defense contractor town, it's a military town. It's we have border traffic. So there's a lot of things that really helps hold us up. That gives us a nice advantage to holding us up during economic uncertainty or downturn. So those kind of things are important. The part that's going to be difficult is that the cost of living continues, and this is everywhere. But I think the U.S. Daily News or U.S. News, I think I just saw it a couple weeks ago, shows San Diego is #1 as the most expensive place to live now in the country, and that makes it really hard for members. So I see, going back to that other graph that you showed, employers allowing others to move out, maybe because cost of living is cheaper. They can still monitor their productivity out of the elsewhere. The one thing I would be interested to see what happens for employers that allow that is, what wage are you paying? Are you paying a California wage, or are you paying a wage to wherever the person moved to? Because if it's a California wage, that's pretty great. That's a pretty nice win. If you can get that at a different wage from the employer's perspective, that could be a win too. If you're paying a different wage, but that doesn't really help the economy if that money is being spent, that employee is spending that money elsewhere. So it's going to be interesting where some of those things turn out. I do think that, although I think things, I think there will be some economic downturn. How much? It's hard for me to say. I think we'll fare through okay, but I do expect things to slow. So I know a lot of people want rates to go down. I know a lot of people are sitting on the sidelines, ready to buy a home, do those things, and those things might change if rates continue to go down, but you're out of a job. And so some of those things you might have been waiting for, there could be other uncertainty that just the consumer is not, it's on their horizon yet. They don't know it's going to happen. And really, that's for us to continue to offer competitive products. It's funny, we have on our consumer loan products, we have nearly the last few years about 80% approval. So 4 out of every 5 members who wanted loan, consumer loans, got a loan. And the thing is, though, there's sometimes you do have to say no. And, giving someone a loan that they can't afford or that over obligates them is not service. But that doesn't mean the relationship should end. And what really should happen then is that's where the relationship begins. And that's where it's like, look, this is what you have to do, member, to in the next 3, 6, 9, 12 months. So next time we can say yes, but let's go through this together. And I think we're going to see a lot more of members looking for financial guidance in the coming months, especially when there's economic uncertainty. Sometimes it's like something bad hasn't even happened yet, but they're just preparing for it, and it could be mentally stressful especially when you have a family and other things, and that you're trying to look out for. And so I think the credit union industry specifically, because we do prioritize on membership, is going to see, maybe you won't see it on that doesn't show up on a balance sheet, but
Yeah.
service does show up, and that's probably where we'll see it more in the next, I don't know, probably 12 to 18 months, if not, a little bit longer, is being there for our members, more financially advising, that we might not, that doesn't show up anywhere on the scorecard.
You bet. Yeah. And I think one of the things that some of the data I showed also point to is that while inflation is coming down, it's not going below zero, which means it is slowing in its rate of growth, but it's still pinching our lower to middle income members who are seeing inflation as the classic way economists think about it, is like a regressive tax. So how much more
Oh,
they're behind the eight ball,
absolutely.
how much the higher rates have expanded their cost of credit. And what I kind of think of as next year is going to be one of those years where credit unions really stand out by saying, look, you may have had a credit card with another lender or with another institution. And now when you come to us, let's try to, under lower rates, let's take the debt that you've compiled because you had to kind of keep your household going while you had inflation. Let's combine everything together and get you at a lower rate in such a way that we're going to relieve you of some of that stress. I think if there's one thing I've seen over my time as an official has been, and just knowing the credit union industry, has been, that seems to be the real standout way that the credit union difference works for people, is that I take the decisions you had to make, and I make a better tomorrow out of thinking about the next 5 years for you. And hopefully lower rates are
Absolutely.
going to allow that kind of relationship to blossom.
Absolutely, and that's really where I think credit unions, and I know we've seen, you really want to be there for your members and help them. Sometimes it's not about interest rate; it's about cash flow, and sometimes consolidating loans and obviously getting a better interest rate and all those things. A reamortization definitely helps with those, and even in your inflation numbers, the thing is, even when it's shrinking, over the last year of a hike, but
That's right.
if you look back 3 or 4 years ago, it still might be a lot lower. Maybe incomes didn't keep up, or nor standard merit increase and those things. So even if it flattens out, it's still pretty expensive. And so, our members are gonna have to keep going there. So to your point, giving them loan products and those kind of things and helping them and advising them is gonna definitely be something that I think that's what always makes us stand out as an industry.
You got it.
Are those relationships, those products.
You bet. And that cash flow thing, you nailed it on that one, is that it's sometimes it's not necessarily about the consolidation of debt or reducing what you're paying in interest, but just relieving a little bit more cash flow that gives me a little bit more stress relief at home. And then we'll, work on it over time to kind of just knock it down. But without that additional cash, I can't do anything. Awesome.
Absolutely.
Well, Richard, thank you for your time today. I think that was a great take on what's going on down there from you and kind of your viewpoint on how the lending market's evolving. And folks, thank you so much for spending the time with us today and hearing what we had to say. We'll be back in 2024 with more from the Credit Union League. And take care. Have a great holiday season.